You've maxed out your 401k and IRA for the year. Now where do you invest? Can investments in a taxable account actually be tax efficient? And is one librarian's investing success story something you should emulate? We'll answer these questions and more on this, the 84th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. Well, today we've got a great question that a reader sent in, actually two questions, although I'm going to talk about both of them, although one is more of the focus, and that is what happens when you've maxed out your 401k and IRA for the year. Where do you invest? Well, I think the first thing you do is you celebrate. That's the first thing you do. If you've maxed out your 401k and your IRA, I think it's time to throw a party and then figure out what you're going to do with all the rest of the cash that's burning a hole in your pocket. We're going to talk about that today, as well as another question that was part of the email I received. Before we get to that, two things. One, I'm going under the knife tomorrow. I tore my meniscus trying to do something that I guess a 47-year-old guy shouldn't do, which was a thing called mental toughness. Apparently, I have none, as it turns out. It's this crazy workout that's part of this sort of CrossFit kind of program that my wife and I do. But I thought I was younger than I am. But this mental toughness, and you just do crazy things like lift 100 or 150 pounds on a trap bar and try to walk a quarter mile, dumb things like that. And I tore my meniscus about 6 months ago. And I was kind of hoping that it would heal itself, although the doctor told me it probably wouldn't. So tomorrow I go in and they're going to take care of it. I'm told it's a very simple procedure, but we'll see. So I got that going on tomorrow. That's the first thing. The second thing is story was interesting that I found on CNN. I shared this on Twitter and Facebook. I've mentioned this before. I tend to share a lot of articles that I find interesting on Twitter and Facebook. You can follow either one. You don't need to follow both. I tend to put the same thing up on both. With Twitter, it's just at DoughRoller, and for Facebook, it's just facebook.com/DoughRoller. You can, I guess, like the page, and then you'll see some of the stuff I post. But this was a CNN article entitled "How a Librarian Taught Herself to Invest and Retired Early." Now, I loved the article, and the librarian has done a great job, but there was one thing about it that as I read it, I kind of like, oh, no. And it was this. In January of 2008, this would have been before the market started to go down, she got nervous. In fact, she said she got panicked, and she sold everything, I guess everything, out of the stock market. And then at some point, and I don't think the article actually says when, she bought back into the stock market, I guess after the crisis was over. I don't know if we're talking end of 2009, 2010. It doesn't say, I don't believe. But of course, she bought back in at a time when the market was taking off again. She made a lot of money, and she was able to retire early. It's kind of a fun story for her. It's just the question is that something repeatable? Is that something that we should follow? It's a good question right now. In the middle of 2014, stock market's up, Dow's hit a record. Should you sell? Are stocks frothy? Are they overvalued? Should you sell all of your investments in the stock market and then just sit and wait? It's not something that I'm going to do, and in part because I've learned that I'm not good at timing the market. And when I think about this article, that aspect of it, it's really, they could have just said she won the lottery. I mean, because for every person that timed the market perfectly, and remember, you got to time it perfectly twice when you sell, and then when you buy back in, you got to get it right twice. I've just got friend after friend, family member after family member, acquaintance after acquaintance that after the 08, 09 meltdown, I guess you could call it. They sold, and now they're just kicking themselves. They just regret it. So, it's an interesting article. You can check it out. Again, if you just go to either my Twitter or Facebook account, you'll find it, or you could just Google how a librarian taught herself to invest and retired early. An interesting article, but on that part of it, I'm not so sure. Curious if you've timed the market perfectly. I'd love to hear about it. Shoot me an email, dr@doughroller.net. Tell me you think that's the way to invest, or maybe you don't, but you did it once and you got lucky. That's certainly possible. But it's a good question to be asking now because so many people think the market is overvalued. Okay, well, anyway, that was the article that caught my attention. I shared it on Facebook and Twitter. Curious what you think about it. With that, let's get to the readers' or the listeners' email, and it's from a person named Harriet, and I apologize in advance if I've butchered your name. Believe it or not, I actually spent time Googling the name to see if I could pronounce it right. That's the best I could come up with. But they write in and they say, I am a little obsessed with your podcast. I listen to about one a day. It's been a very helpful tool. I'm still catching up on all the podcasts, so I am a few behind, but I just heard podcast 25 and wanted to know how often you should rebalance your portfolio. Also, on a different note, after maximizing out my 401k and Roth IRA, what other tax-deferred vehicles do you recommend? A few I have heard of are a non-deductible IRA, a health savings account, and an annuity. Or should I look to invest in a taxable Vanguard account? Any thoughts on those? Thanks again for all your help and all that you do. Well, that's two great questions. In terms of podcast 25, and let me look that up for you, make sure I remember what that is. It seems so long ago, but podcast 25 was how to create an asset allocation plan. So you can check that out, DoughRoller.net/podcast 25, podcast 25. I've also talked about rebalancing, and the listener may not have gotten to those podcasts yet. Those are podcasts 51 and 52, DoughRoller.net/podcast 51, and then also DoughRoller.net/podcast 52. But it's a good question. And so here are some real quick thoughts on how often you should rebalance. And then we're going to get to sort of the heart of the show, dealing with where to invest after you maximize your retirement account. So how often should you rebalance? Real quick here. One, there's no one right answer. Two, in my opinion, once a year is fine. Three, I evaluate them every month. I think it's important to tell you that. I say once a year I think is fine, but then that's not what I do. I think it's only fair to share that. I evaluate usually every month when I redo my net worth statement. But I don't know, anal. I don't think most people need to evaluate every month. By the way, that doesn't mean I make changes every month. It just means I evaluate every month. I would say I probably only make changes once or twice a year. For purposes of asset allocation. 4, I do evaluate when there are big moves in the market. So I'm really keeping an eye on it now. The market was up last year. I rebalanced at the beginning of the year, and it's been up some this year, not like last year. It's not, it's in the news because records are being set. The Dow hit 17,000, but the S&P 500 is not up. I think it's up, I want to say 7% this year, something like that, through half the year. Certainly a good year, but last year was up 32%. But I'm still keeping an eye on it. But again, primarily I look at it once a month. The fifth and final thing I'll say on how often to rebalance is this, and I think it's probably the most important part of all this. Whatever you do, have a plan and stick to it. If you're going to do it once a year, fine, do it once a year, but do it every year. And what's going to happen is, the stocks are going to be on fire, and you're going to look at your year's going to come up, or 6 months or quarterly, whatever you've decided, and you're going to look at your balances and think, man, if I'm going to rebalance, I got to sell $20,000 in a stock mutual fund and put it, which is just doing great, and put it in a bond mutual fund, which is lagging, if that happens to be the case, or the other way around. Maybe stocks are just in the dumpster, and bonds are just doing great, and you think, man, I got to sell some bonds and invest in a 2008, 2009 kind of market. That's awful. But that's what rebalancing is. And actually, that part of rebalancing can be very helpful because it causes you to tend to sell high, sell the things that are on fire, and buy low, buy the things that aren't doing so well. And in the long term, that can be a very prudent way to invest. More importantly, it's really the only way to stick to the asset allocation plan that you've decided is best for you and your family. So I think whatever you decide, again, there's no one right answer. Whatever you decide, whatever your plan is, stick to it. I think that's the most important aspect of rebalancing. Okay, now on to the sort of the main part of the question. So you've maxed out your 401k. In this case, they've maxed out a Roth IRA as well, and now they want to know where should they invest. Now, again, the first thing you need to do, I think, is have a cookout, a party, something to celebrate that you've put a lot of money away for retirement. So I'm going to give you a couple of thoughts on what you can do next. Not all of these will apply to everybody, but some of them hopefully will apply to you, and you can use them and help put away some more money. So the first thing I want to say is this: for IRAs, for your traditional, there's a mind-numbing array of IRAs. There's not just one, right? You've got your traditional, what people call a traditional IRA. Really what that is an IRA. I think most people, what they mean by that is an IRA that is tax deductible. You put in $5,500 or whatever the amount you're going to put in for the year, and you can deduct it from your taxes, right? So you're putting away effectively pre-tax dollars for your retirement. But there's also, of course, a Roth IRA where you're investing after tax dollars, but then from then on out, there's no taxes, not on what you've invested, not on what you earn. Again, as long as you follow the rules in terms of when you take it out and all that sort of thing. But there's the Roth IRA. Then there's a non-deductible IRA, right, where you contribute to the IRA, but you can't take a deduction, which is the case for many people because of either their spouses or their situation at work in terms of how much they make and whether they have access to a 401k or other retirement plan at work. But those are just a few. Then there's an inherited IRA. If you inherit an IRA from someone, there's a SEP IRA for those that are self-employed. So there's all these different kinds of IRAs. Here's what I want to focus on first. In terms of sort of, I guess I'll call the standard IRAs, what most people think of, the deductible or non-deductible IRA, the Roth IRA. Your contribution limit, $5,500, or it's more if you're 50 or above. But we'll just assume for the sake here, just $5,500 is the limit. Of course, that changes every year as well. But that's your limit for all of those IRAs. In other words, you can't put $5,500 in a Roth IRA and then go put $5,500 in a deductible IRA or even a non-deductible IRA. It doesn't matter. It's an IRA, so you have your limit. It's $5,500. Now, you can spread your contributions across different types of IRAs. So you could put $2,500 in a Roth IRA, and the rest of up to your limit, whatever it is for the year, in a deductible IRA, for example. That's permitted. But all of your IRA contributions for what we're talking about here, not something like a SEP IRA, but for these IRAs, you have to add up all of your contributions, and they cannot exceed the limit for that year that applies to you. And that's true whether you're contributing to a Roth, a deductible, or non-deductible IRA. So that's the first thing. So if you've maxed out your Roth IRA, then you can cross the IRA off your list of options. Again, we're talking about these basic IRAs, not a SEP. I'll talk about a SEP IRA in a minute. But you can cross out the IRAs after that for that year as an option for you. So that takes care of that one. Now, I mentioned a SEP IRA. I just want to throw this out there. If you're self-employed, a SEP IRA can be a fantastic way to contribute a boatload of money for your retirement. I think the limit this year, don't quote me on this, I think it's $52,000. Now, the way a SEP IRA works, and it depends if you're the only employee in your company or if you have employees or if you're an employee yourself, but like if you're an individual, you have your own business, you're a consultant, you're an accountant, whatever, the rule is, I believe, 20% of your net income. I think that's right. So if you make enough and you can contribute that 20% up to a limit of $52,000, which is a huge tax benefit. Now, things get complicated, and this is where if you have a complicated situation, you really need professional tax advice. And as I've said many times, I am not a professional tax advisor. I don't play one on TV. I did not stay at a Holiday Inn Express last night. So, I'm not a tax guy. I hire someone to do all of this for me. But one of the things I've learned from my tax accountant is that $52,000, you have to deduct from that any 401k contribution. So maybe you have a regular, a W-2 job, where you have a 401k, then you have a business on the side. Well, the SEP IRA limit might be $52,000, but that has to include whatever 401k contributions you made. So if you contributed $17,500 to a 401k, you'd have to deduct that from your 52. I think it's 52,000 this year, but whatever the limit is, it's just over 50,000. But again, that's where a tax professional could come in handy. Now, I mentioned that. I don't think that was really the focus of the question, so I'm going to move past the SEP IRA, and I can cover it in more detail in later podcasts. But I just want to point that out. If you have self-employed income, you have other options. Another one is an individual 401k. So those are options that can go above and beyond sort of the normal contribution limits of a 401k or a Roth IRA, something to think about. Okay, the next option, health savings account. This is something that they mentioned. Now, I've covered health savings accounts in podcast 67, DoughRoller.net/podcast 67. So you can check that out if you want more information. The one thing to know about HSAs is they only apply if you have a high deductible insurance policy. That's the only way you can contribute to an HSA. But if you do, they can actually be a great way to extend your contributions for retirement because unlike, say, a flexible spending account, which I use, with an HSA, you don't have to use it all in the year you contribute. It's not use it or lose it. It can roll over from year to year to year. And it can build up, whatever amount you can accumulate. There are you can, depending on where you have your HSA, with whom you have it, you might be able to invest in Vanguard mutual funds, low-cost Vanguard mutual funds, and other things like that. And now the rules are different. I'm not going to go through all the rules, but for example, when you can take the money out for non-medical reasons without incurring a penalty, age limits are different. The contribution limits are a little different than, say, an IRA. So I'm not going to go through all of that. You can check out podcast 67 if you want more details. But it is an option. Again, it only applies for those with high deductible insurance policies, but it absolutely is an option above and beyond your 401k and your IRA. All right, next one, annuities. So we talked with Tim Holmes of Vanguard. If you're interested in annuities, I highly, highly recommend this podcast. Annuities are immensely complicated. It's podcast 73, DoughRoller.net/podcast 73. A deferred variable annuity can be a great way to save additional money for retirement. The money that goes into this annuity is after taxes, but it's tax deferred. The earnings are tax deferred until you start taking money out, presumably during retirement. Now, the problem with these kinds of products is that they can be expensive. There are costs over and above the underlying costs of the investments in the annuity. And so that's something to consider. Even with Vanguard, there are costs. One of the things that Tim Holmes had said was you probably ought to plan on being able to invest in your annuity for a minimum of 10 years in order for the tax advantages of an annuity to exceed the costs. And so costs are critical there. It's something to give a lot of thought to. Obviously, the folks at Vanguard can help you if you want to give them a call. But the starting point there is to listen to podcast 73. So yes, annuities are an option. But again, it takes some careful thought and analysis. Now, having said all of that, we've talked about non-deductible IRAs, SEP IRAs, HSAs, health savings accounts, annuities. Those are all options. I have a SEP IRA, so I do use that with my business, but I don't have an HSA. I don't have an annuity. I don't contribute to a non-deductible IRA, although that's going to change this year because I'm going to convert to that non-deductible IRA and then roll it over to a Roth IRA, what's called a backdoor Roth IRA. And if at this point your head's spinning, you're like, man, you're throwing too much at me. I'll give you just another podcast to go to. Podcast 40, DoughRoller.net/podcast 40 talks about backdoor Roth IRAs. And by the way, I'll have links to all of this stuff in the show notes. So the show notes for this episode, DoughRoller.net/podcast 84, podcast 84. So you don't have to worry about writing anything down or whatever. Maybe you're driving when you're listening to this, or you're on the treadmill. I don't know what you crazy people do when you listen to podcasts, but whatever, you can just go to DoughRoller.net/podcast 84 and get links to all of this stuff. So don't worry about writing it down or remembering it, which, by the way, I listen to podcasts, and that's the one thing. I'm usually listening to them in my car, and there's, good stuff on the podcast, and it's like, I can't write it down. I'm driving. I'm not going to remember it all. I try to remember, I don't. And the show notes are the place to go. Hopefully, podcasts that you listen to give you links to all the stuff they talk about. I know I do in my show notes, so you can just go there. So I say all of that to say, for me, where I put the vast majority of our money after we max out our 401k and IRA is taxable investments. And here's the thing. You can invest in a taxable account in an extremely tax-efficient way. Okay, so let's cover this. Again, I'm not a tax professional, so a lot of what I'm going to tell you is what I've learned just from years of investing and working with my tax accountant. But I'm going to try to keep this pretty straightforward. So for most investments, whether it's in a mutual fund or individual stocks, so you have two potential sources of taxable income. For stocks, it would be dividends, right? Dividend payments that get paid out usually quarterly. If it's a bond fund, it would be interest, so interest or dividends. And then capital gains, where you are selling an investment for more than your cost basis, effectively more than you paid for it. And so there can be capital gains. And of course, capital gains can get more complicated because you can have short-term capital gains, typically capital gains on an investment that you've bought and sold within 12 months. So you bought something in January, it went up in value, you sold it in August, 8 months later, short-term capital gain. Long-term capital gain is when you've sold an investment that you've held for more than 12 months. As you can imagine, all of this stuff can get wildly complicated, particularly if you're doing a lot of buying and selling. But those are generally what trigger taxes in an investment in a stock or mutual fund. The dividends that get paid out, if it's a mutual fund that, just about every stock mutual fund, I think, has dividends, but also individual stocks if they pay dividends. That can trigger taxes, and then capital gains. So with that, the question is, how do you avoid that? How can you invest in a taxable account where you can either completely avoid dividends and capital gains until you choose to sell, right? So you have control over it. Or if you can't completely eliminate them, how can you minimize it? So here are a couple of ways. So first of all, in terms of capital gains, one of the great ways to eliminate capital gains until you choose to sell is to buy individual stocks. So if I invest in Ford today, I'm 47. If I don't sell it until I'm in retirement, I don't pay any capital gains. It's as simple as that. Now, you say, well, that's a 20, 30, 40-year investing horizon, depending on when you end up selling. And my answer to that is that's right, man. That's exactly how I want to invest. Now, I know a lot of folks aren't comfortable investing in individual stocks, and that's fine. I do. It's becoming, in fact, a much more important part of my overall investment. Again, as I've said in many shows in the past, my core portfolio is in low-cost index funds. But I would say my individual stocks today, I'm just trying to think here, are roughly 20% of my portfolio. And I think that's going to grow over time. So with an individual stock, you buy it, you hold on to it as long as you want, and you don't pay capital gains until you sell, hopefully, right, at a gain. Now, you could be saying, well, what about the dividends, though? These stocks do pay dividends, and certainly Ford, for example, pays a dividend, and that's right. I have to pay taxes on the dividends that I receive. I reinvest them automatically back into Ford. Ford's just one example. I own shares of Apple. It pays a dividend. I reinvest the shares back into Apple. I own shares of Wells Fargo. Same thing. Dividends get paid out. Although that particular security I own in my SEP IRA, so I don't actually pay taxes on the dividend. But the point is, with dividends, I am going to pay some taxes, and that's what I've accepted. It's not perfectly tax efficient, but it's really, really close. Now, there are some great investments that don't pay dividends. One that comes to mind that I own is Berkshire Hathaway stock. Warren Buffett is famous for, among other things, not paying a dividend. And so with my Berkshire stock, I don't have any tax liability until I choose to sell it. Now, there aren't a lot of investments that I would put into the category of Berkshire Hathaway. And again, I'm not suggesting that you go off and invest in Berkshire Hathaway. That's only a decision you can make. I'm not recommending it as an investment to you, to anybody. I'm simply telling you that's what I do and explaining one of the reasons is it's an incredibly tax-efficient investment. That's why I kind of cringe. I was at the Berkshire Hathaway shareholder meeting this year. I took my son in May to Omaha, and some of the investors in Berkshire are starting to complain that it doesn't pay a dividend. And I'm going to actually have a number of episodes. In fact, if they go according to schedule, it'll be this month, talking about dividends, what they are, how they're important, how to analyze them, what they're good for. Are they a good way for retirement income, for example? But the thing is there are a lot of downsides to dividends. For example, one, they're taxed, right? If they're not in a retirement account, they're taxed, which is what we're talking about here. Two, you don't have control over how much the dividend is, right? And not really. The management decides what the dividend is going to be, and you don't have any control over the timing. I mean, you know when it's going to happen. It's usually every quarter. But you don't have any control over the timing. And so for Berkshire Hathaway investors, I'm scratching my head. I'm saying, look, if you want some income, just sell some of your shares. Now, psychologically, people have a hard time doing that. They somehow think dividends are better than selling a share. They're not, but we'll dive off of that issue later. And if, by the way, you're listening to this and you're thinking, Rob, what are you talking about? Of course, dividends are better than selling your shares. Well, let me get to those podcasts and hear me out. And before you shoot me a mean email telling me I'm crazy. Well, you can shoot me the email now and tell me I'm crazy if you want. But in any event, back to this topic. Berkshire Hathaway stock is an example of it's as tax efficient as an annuity, right? The annuity, you invest after tax dollars, but you don't pay any taxes on the earnings until you decide to spend the money, right? Berkshire Hathaway stock, exactly the same way. I'm putting after tax dollars in to Berkshire Hathaway stock, and I don't pay a nickel in taxes as long as I don't sell the stock, which I don't. So that's one way to be tax efficient in a taxable account, is to own individual stocks. You're not going to pay any capital gains until you sell. And you may pay some tax on the dividends if the company issues a dividend. Some don't, like Berkshire. Some do, like Ford, Apple, Wells Fargo, and so on. Yeah, you'll pay a little bit of taxes, but still overall a very tax efficient investment. Now, what about for everyone that says, I'm not really comfortable investing in individual stocks? What about me? No problem there. There are plenty of tax-efficient investments in mutual funds and ETFs. So let's run down these kind of quickly. ETFs are generally considered more tax-efficient than mutual funds. I'm going to give you a couple reasons. I'm not going to give you all of them because, frankly, some of them get wildly complicated in terms of the structure of the ETF, what it invests in. They can be very inefficient, actually. If they invest in, say, gold and silver and are classified as collectible for tax purposes, I'm not going to get into all of that. What I will say is this: there's two, in my view, primary reasons why ETFs tend to be more tax efficient than most mutual funds. The first, many ETFs track indexes. And as you know, there's not a lot of buying and selling. They have to buy a little and sell a little to continue to track the index. But it's not as if some manager is saying, I've got $100 million in Wells Fargo today. I don't like that investment anymore. I'm going to sell it and buy Facebook. That would be a terrible decision, by the way. Anyway, it's all of a sudden they're doing all this buying and selling. Well, with an index, with an ETF that tracks an index, they're not doing that. They're just tracking the index. So there's some buying and selling to keep track with the index, but that's it. Now, you may be saying, well, wait a minute, Rob, there's mutual funds that are index funds, of course. So isn't that the same thing? Yeah, it is. That's absolutely true. Except that there are a lot of actively managed mutual funds that are not very tax efficient. With ETFs, majority of them track indexes, and for that reason, they tend to be very tax efficient. But yes, mutual funds, index mutual funds, very, very tax efficient. Okay. The second reason I want to mention that ETFs tend to be more tax efficient is this. when you sell a share of your mutual fund, you're selling it back to the mutual fund company, and they have to take cash and they have to buy you out. Well, what happens if it's 08, 09, people are scared, they're running for the exits, and millions and millions of shares are being redeemed at the mutual fund company, and they don't have enough cash to redeem all these shares? What are they going to do? Well, they got to sell some of their investments. They got to sell some of the stock. And that can trigger capital gains. They sell that to generate the cash. They pay out the investors who want out of the investment. But for those of us that are long-term investors, we have our asset allocation plan, and we ain't afraid of a falling market, right? We're stuck getting hit with all these capital gains because of the scaredy cats that are running out of the stock market, right? Well, with an ETF, it doesn't work that way. When you sell a share of an ETF, by and large, you're selling to another shareholder, or a new shareholder, just like you are when you sell a stock. You're not selling it back to the mutual fund company, right? It's not a transaction between you and the mutual fund or ETF company. It's between you and some other third-party shareholder. So the ETF doesn't have to liquidate some of its securities to buy your shares back. ETFs, for those reasons, can tend to be more tax efficient than your average run-of-the-mill mutual fund. Now, that being said, as I mentioned earlier, index mutual funds, like the kind you might buy at Vanguard, an S&P 500 index fund, total market stock index fund, tend to be extremely tax efficient. And again, they're not buying and selling to pick stocks. They're simply tracking an index. And these well-known funds like Vanguard that have been around for a long time have learned how to run their mutual funds in a very tax-efficient way. And so I think those, ETFs are one option in your taxable account, can be very tax-efficient. Don't assume that they are, because there are some ETFs that have high turnover of their investments, and depending on what they're invested in, how they're structured, are not tax-efficient. Don't assume just because it's an ETF, it's tax-efficient. But many of them are. Index funds, mutual funds, can be tax efficient. Now, at this point, though, you're saying, okay, I got that, Rob, but if I can't assume that an ETF is tax efficient, you're telling me index mutual funds tend to be tax efficient. But how do I figure all of that out? Well, a great tool, I think I've mentioned this before, but I know folks have emailed me about it, is Morningstar's what they call tax cost ratio. And they have some tools. So if you go to Morningstar and you search on a fund, and I'm looking at Morningstar now, I'm going to search on VOOV, which is a Vanguard fund. It's a value fund. It's a Vanguard S&P Value Index. So it's an index, and this actually is the ETF version, but this will apply for the mutual fund version too. So this will apply with ETFs or mutual funds. I want to walk through a couple of things you can look at in Morningstar. So the first thing is when you look up a mutual fund or ETF, there's the navigation across the sort of the middle of the screen. It's right below the name of the fund. One is called tax. It's just tax. That's the heading. If you click on tax, what it basically shows you is the impact taxes have on the returns you might earn, and they also have what they call a tax cost ratio. So for VOOV, for the 3-year period, their tax cost ratio was 0.55. So you can expect to lose about 0.55 of your return annually to taxes. Now, you may not pay your taxes out of that fund, right? You may pay them out of your checking account. Still, it doesn't matter. It's still money that you're losing, right? And so it's 0.55. That gives you an idea of what you will be losing to taxes, and that's the 3-year period. They also show the 1-year period actually was 0.9, so it's a bit higher. So this gives you an idea of just how bad the taxes might be for this particular fund. Now, there's also a tab called Distributions, and it will show you what the actual distributions were for this fund. It goes, in this case, it shows you from 2010 to 2013. What's interesting is there were no capital gains distributions for this fund, short-term or long-term, none. But there were income in the form of dividends, right? I don't know if they own any bonds in this fund. I wouldn't think they would. But in any event, it should be dividends from the underlying shares that they own. Again, this is an S&P 500 fund, but it's a value-based fund. So it's a little different than owning the S&P 500. But the point is it will show you the distributions that they've had each year on a per share basis. Again, divided between dividends, short-term capital gains, and long-term capital gains. And this can help you figure out just how tax efficient the mutual fund is. Now, one last thought on this tool. I kind of set the gold standard at Vanguard's S&P 500 fund. So I'm looking at their VFIAX, which is the Vanguard 500 index. It's their Admiral shares. And for the 10-year period, their tax cost ratio was just 39 basis points. That's an extremely efficient mutual fund. Now, over the 1 year period, they were actually as high as 84 basis points, 3-year period, 53 basis points, 5-year period, 44 basis points. I don't know why over the last year they were at 84 basis points. It could be because the market was up so much and there was just a lot of movement and they had to do more buying and selling to track the index, but I'm just guessing. But over the long term, you're basically losing 39 basis points in your performance. And by the way, not insignificant. We shouldn't just dismiss that as unimportant. I'd much rather be able to defer those taxes for 40 years while I save for retirement. But again, what we're looking at is a situation where you've maxed your 401k, you've maxed your IRA. If you have access to like a SEP IRA or I401k, you've maxed those out, and you're looking at options. To me, I kind of use that S&P 500 fund as sort of the gold standard, and then I compare other funds to it that I might be considering. And so like I look at American funds, the AMCAP A shares, but this is one of those front-loaded mutual funds. I would never, for me, it's just not consistent with my investment philosophy. But just to give you an idea, their 1 year tax cost ratio was 215 basis points. Now, that was pretty significant. It does drop off below 1% in the 3, 5, 10, and 15-year period. But just to compare to the Vanguard fund, at 15 years, it was 82 basis points. Vanguard doesn't go out that far for this particular fund, but for 10 years, it's 39 basis points. So that's how I look at it. That's how I compare from one fund to the next. But I think for me, that kind of investment in taxable accounts where it's tax efficient, for me, it's either individual stocks or very tax efficient index funds. The other thing I invest in my taxable account are a municipal bond fund, a muni fund, invests in bonds issued to municipalities. Could be hospitals, local governments, that sort of thing. And there are certain federal tax breaks that you get from that make them very, very tax efficient. So that's the other thing I do. But I think generally you can structure taxable investments or investments in taxable accounts to be very tax efficient. You may not get quite the same tax efficiency you get with an annuity, but when you compare it to the cost of the annuity, and depending on where you open the annuity, the limitation in investments, for me, it's just the choice that I prefer. Again, annuities are an option. Again, an HSA is an option if you have a high deductible insurance policy. Obviously, as I mentioned, SEP IRAs and I401ks and other options. So, again, if you're confronting this, it's a great problem to have. Congratulations. Those are my thoughts on it. That's how I deal with investments in taxable accounts. The other thing is when you're just starting out, it's like, what does it really matter? I've got $1,000 in my taxable account, $2,000, $5,000, $10,000. It's not generating a lot of taxes. But, that 10 is going to turn into 20. Believe it or not, it will. And then it'll turn into 50. And then $100,000, it will. 250, 500, $1 million. Believe it or not, if you keep investing, keep your costs down, stick to your plan, all of a sudden, the day will come, it'll hit you. You'll remember it. It's like, man, the taxes, they're brutal. But what in the world's going on? In fact, I got out of, actually it was a Vanguard fund, and I don't remember which one it was. This is when it hit me. I was invested in, this was back in 2003. I bought the Vanguard Emerging Fund. Believe it or not, I didn't even know what an emerging market was when I bought it. It seemed like a international fund. I bought it. I'm sorry to say. It turned out to be a great investment, but I didn't know what I was doing. And I invested in another international fund at Vanguard. I can't remember what it was, but the taxes were brutal. And after a couple of years, I just said, this is crazy. I can't keep paying these taxes. And that's when I started to realize, this investing, it works. Compounding works. It starts to add up to some serious money, and then you really do need to worry about the taxes. So if you're not there yet, but keep working at it, you will be. And I guess taxes being a problem, it's a good kind of problem to have, right? Well, there you go. Those are my thoughts on what to do when you've maxed out your available sort of obvious retirement investing options. Hey, if you've tried other things, or any of the ones I've listed and they've worked for you or they haven't worked for you, you like some, you don't like others, whatever, shoot me an email. Would love to hear from you and to get your thoughts on this. And as you know, I share a lot of this stuff on the podcast for others, so we can all benefit from what you all share with me, which has just been fabulous. So would love to hear from you. dr @DoughRoller.net. Shoot me an email. And as I mentioned, if you don't already, follow either DoughRoller on Facebook, facebook.com/DoughRoller. I guess they call it liking the page. Or you can follow the Twitter account @DoughRoller. And as I mentioned, I send out usually daily several articles that I find of interest, and you can see what I'm sharing with everybody there. And so, again, if you have any questions, comments, whatever, shoot me an email. Would love to hear from you. dr@DoughRoller.net. Hope you have a great day. And remember, until next time, the best thing money can buy is financial freedom.